$225,000. That's how much my wife and I have invested in our dividend stock investment portfolio. In this video, we'll be reviewing this portfolio, and we'll sharing with you why about half of that investment is in one single exchange traded funds, and why we plan to add another $20,000 and buy this specific ETF in the week ahead. Let's get into it. Here's a quick look into our stock investment portfolio, our dividend portfolio that my wife and I have. Currently mainly invested through Wealthsimple Trade, but we do have some of our funds, mainly our Smith Maneuver, through Questrade. You notice how the total balance of our portfolio is just shy of $226,000, over $225,000, and the largest exposure here is through our investments in VDY. We have $51,000 or so in my account, and another $44,000, close to $45,000 invested through my wife's account, and that gives us that exposure of close to that 45%. You notice here in terms of the breakdown invested in VDY, and that's the Vanguard FTSE Canadian High Dividend ETF offered by Vanguard Canada. Although we are invested almost half of our funds into this ETF, our target is to reach to that 65% exposure to VDY. There are a number of reasons for that. We'll dive deeper into VDY and what makes it really our top pick when it comes to dividend investing. We'll get into it in a moment, but before that, I'm going to quickly walk you through the rest of our positions here. Over the past week, we've been aggressively buying more shares. We've definitely added to our shares of VDY. We also bought shares of VEQT, VFV, as well as some shares of Canadian banks. Where things are at from that lens, you notice about 35% of our funds here are in VEQT, or Vanguard All-Equity, all-in-one kind of ETF. It gives you exposure to a wide variety of 100% stocks, but these are geographically diversified as well as diversified by different sectors throughout the world. And that's how we are getting that more of a diversification. We intend to lower our exposure here by bringing it down from 35% to 20%. The way that we are going to be doing it by putting in more funds and mainly using that funds to invest in VDY. The other exposure, top exposure that we have is in VFV, or Vanguard S&P 500. It gives us the exposure to invest in the top 500 companies in the Standard & Poor's index of the US companies, but our exposure is to the Canadian dollar, so we don't have to buy them in US dollars. That's really easy for us. We have currently about 15% exposure to that. We want to lower that exposure to 10%. You do see here a column that we've added is the amount of expected dividends that we can collect in a year, approximately, by investing in these funds based on the amount of shares that we have. The largest amount of dividend expected is from VDY, currently at close to that $4,000 in a year, followed by about $1,200 from VEQT. And VEQT does pay its dividend distributions annually, only once per year in January, followed by then the dividend distributions received from VFV. This is the expected annual, though VFV does pay its dividend distributions on a quarterly basis. The one thing that we love about VDY is the fact that it does pay its dividends on a monthly basis. So every month we can collect some amounts of dividend, and that's something quite nice for those folks who are trying to build a portfolio of passive income for themselves. In terms of our overall portfolio performance, the book value of it is $225,709. The market value is slightly lower at $219,992. In other words, this portfolio is currently down by about $6,000, or a negative 2.5%. And that's how much this portfolio is down. If you look at line by line, the different holdings that we have, for the most part, all of them are in the green territory. This is quite a turn of an event compared to last week, in kind of a testament to how the stock market has done in the last week for us. The ones that are currently negative, mainly we have our Smith Maneuver portfolio, VEQT, down by about 11%, though it's showing some signs of recovery, followed by Bank of Nova Scotia. That's another one that we are down by about 6%. Other than that, for the most part, anything else is either in positive territory or just a fraction of a point, perhaps less than 1% in negative territory. That's where things are at. If you look at the dividend distributions, you're seeing the dividend yield as well as the yield on cost and the expected dividend for each one of these holdings and the number of shares that we have. We are currently expected to have a total of $6,219 in terms of our dividend distributions per year. That translates to a monthly average of $518 in dividend income, which is quite nice. Our goal is to grow this to much larger place. The idea is if we are able to build this portfolio into a much larger position and building it into a much higher expected dividend income, at one point you would be able to get to the level whereby your dividend income is allowing you to cover your monthly expenses, and that's the best case scenario. You would be able to reach almost that financial independence stage. Definitely, it's a long-term plan. It requires a lot of financial discipline and aggressive and continuous saving and investing, but something that we are working towards. Just for fun, what this amount of dividend, the $6,200 translates to, is almost equal to average daily of $17 in dividend income. Not too bad, eh? That's where things are at. With that, now we're going to move on and do a little bit of a deep dive of the VDY, the one that we talked about. We have closer to half of our investments currently here, and the one that we intend to put in another 20,000 or so into it in the week ahead. VDY is the FTSE Canadian High Dividend Yield Index ETF. You notice the last trading price for that is $42.03. In the last trading day, it was up by about 0.6%. It has a management expense ratio of 0.22%, which is considered to be relatively low for us. What the advantage of this ETF is, exchange traded fund, is that it gives us exposure to a basket of stocks, high quality Canadian stocks that pay high dividends. Really, it helps us to really not have to worry about going and doing a lot of research and handpicking different stocks. Really diversifies our investments through that approach. Then different stocks that are kind of you're getting exposure to, we can take a look at it in a moment. Let's just hover down. You're getting exposure to about 47 different stocks in Canada. These are the likes of companies such as Royal Bank of Canada. These are the top holdings. Toronto Dominion Bank, Enbridge, Bank of Montreal, Bank of Nova Scotia, Canadian Natural Resources, TC Energy, Canadian Imperial Bank of Commerce, Suncor Energy, and Bell Canada. These are the top holdings. If you want to look at specifically all the 14 holdings, you can simply click on that on the button here, and it exports it into a file for you, and you can take a look. In terms of the sector exposure, not surprisingly, as you heard some of those names, majority of your exposure is to banks. So financial sector is the top of the list with about 55% of your exposures. Energy is the second biggest exposure here by sector breakdown at 26%, followed by telecommunications, utilities, consumer discretionary, basic materials, industrials, and real estate. Those are getting a lot less exposure, as you're noticing, but that's how your exposure is. All of these companies are Canadian, and that's why the dividend that you're getting is treated very favorably when it comes to taxation perspectives. In terms of the size of these companies and the market cap, majority of these stocks and companies that you're invested in are considered to be large cap, with about 91%, followed by about 2% of them are medium large, and another 3% or so are medium size. In terms of medium small size, we are getting exposure to 2%, and the small size is only about less than 1.5% of these businesses. We love VDY for a number of reasons. A is the fact that it does pay its dividends on a monthly basis, which means it's perfect for a passive income investor and those who want to count on some sort of dividend income coming to their account every month. That's lovely in that sense. The diversification that it provides you is another reason. Diversification through investing in high quality dividend paying Canadian stocks. Make it super simple. The other aspect of it is that this fund has been around quite some time. In fact, close to that 10 years. It was incepted back in November 2nd of 2012, coming to that full 10-year in a matter of days. Which is why if you look at its performance, as an example, let's take a look at the month's end. And this is as of September 30th in this case. If you look at it, for the month ending in September 30th, that month, this fund based on market price was down by 4.5%. which might be perceived to be negative. But keep in mind, you want to, when it comes to looking at the returns, you don't want to look at it just short term, because of course the stock market has been doing poorly over the different months too, or different years. You want to more so focus on a longer term horizon. As an example, if you look at year to date, again showing to be down by 4.6, telling us that might be the perfect time, because September most likely was a really downturn kind of months for this ETF. That's why we've been aggressively buying these shares. The 1 year, if you look at September 30th all the way to 1 year prior to that, the stock, this ETF is up by 3.1%. The 3-year return for us, and this is annualized return, is showing to be at 9.3%. 5-year annualized return of 7.8%, close to that 8%. And then you don't have quite yet the 10-year, but once you reach that November timeframe, you would most likely have that 10-year return as well. In terms of the inception, return since inception, annualized, you're looking at 8.8%. That's quite a bit of a longer term look. With this ETF, if you're invested for the long term, you can expect on average that 8% or plus return, which is quite decent for something that you don't have to do any homework for and really passively invest in it. Let's take a look at the returns annually. I'm just going to show you by different years since its inception how this fund has returned. In 2013, this fund and this ETF, based on its total return by market price, let's look at that because it's the market price for the fund, depending on what price you bought it at. In that year, it was up by 20%. 2014, it was up by 8%. 2015, it was a downwards year for it. It was down by negative 10.5%. 2016 recovered very nicely, returning you 26.5+%. 2017, modest return of 8%. 2018, it was down by 10%. The next year, again, recovered very nicely, giving you a return of 21%. 2020, slightly down by 1%. And then 2021, again, recovered very nicely, giving you a return of 36.6%. One thing you're starting to notice that the years that this fund does poorly, almost immediately the year after, it's doing just amazing, almost double-digit return, well surpassing and outperforming its negative return on the year prior to that, which is why we are quite bullish about this fund. If you notice, year to date, this fund was down by about 4.5%, which if history kind of shows to be again true in future, not a guarantee for that, but if it does repeat itself, you can anticipate that 2023 would be a phenomenal year, most likely for this fund. And that's why we want to take advantage of that by pick up as much shares as possible of the VDY in this year. That's about the return by year. And let's take a look at cumulative return. If you had invested since the beginning of this fund over the different time horizon, how that would have panned out. You notice the 3-year for VDY by market price would have given you a 30.6% return cumulative. 5-year, it would have given you a 46% cumulative. And then the return since inception, which goes back again, as we pointed out, around that November of 2012, you would have seen 131%. You would have more than doubled your return in a matter of less than 10 years. Just remarkable returns for a wonderful, high-quality, passive investment ETF for you. And also, this graph shows you how your funds would have grown if you had invested $10,000 over the different span of time. Like, for example, if you had invested $10,000 by the end of September, that would have turned into $22,929. At one point, it would have even been as high as $26,000, close to that end of March of 2020. But you'd see how the funds go up and down. For us, VDY is really going to be a avenue for us to rely more on a dividend income. We don't want to necessarily consider selling it, and rather keeping it for the appreciation, but more so for the dividend distributions that we're going to get every single month from it. We did cover the fund's specifics, its exposure in terms of geographical distributions, which is all in Canada, in terms of the sector breakdown, in terms of the funds that mainly are invested in. The one last piece that I want to bring to your attention is that this fund in the past year had hit the highest price of $47.76, and the lowest price that it had hit was $39.05. In other words, right now it's hovering a lot closer to its 52-week low price at $42 currently that this fund is being traded on. In other words, it has still another 18% or so to reach its 52-week high price to match that level. The upside that you could see easily getting there. In terms of their dividend distributions, the last time that they paid their dividend distributions was at 20 cents per share. You can see here how every month what different amounts they've paid. The next upcoming distributions for this fund is expected to be paid out on November 8th. This is based on the ex-dividend date of 31st of October, and it will be for the amount of around 11 cents per share. The amount of distributions, the dividend distributions are changing. It's not always the same amount per month. It differs, but on average, we are anticipating roughly that 4% or so per year of annual distributions if you add them up and do the math in terms of where things are at for the fund. For instance, you see the 12-month trailing yield is at 4.33%, and the distribution yield as of September 30th, it was at 6.24%, assuming the distribution that was paid at the time and based on the closing price for the fund for that month. There you have it, folks. A quick look into the funds that we have in our dividend stock portfolio and where things are at with our portfolio and what's our plan for the week ahead in the stock market. As I indicated, we are planning to add another 20,000 or so to our funds in the week ahead in the stock market, mainly using that to invest in VDY, but we will gradually pick up some additional shares of VFV, VEQT, as well as some shares of XEQT and XDIV. Those would be very minimal shares, most likely one or two, but the ones that we are going to be massively investing in would be the VDY, and that would be in hundreds based on the $20,000 that we were planning to put in the stock market. Stay tuned for our update next week as well, and we will show you what specific stocks we picked up at what prices, and we'll provide that update for you. I hope you found this video beneficial and gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week videos about investing in the stock market, including dividend stocks, growth stocks, penny stocks, and real estate. We also talk about ways to reach financial freedom and financial independence. Let us know, of course, in the comment section down below if you are invested in any of these stocks that we talked about, any of these kind of funds and exchange traded funds, and what your vision is for this year, the rest of the year. What funds are you trying to pick up in the stock market during these downturn markets? Love to hear from you. As always, thank you so much for watching this video until the end, and I hope to see you all next time.